All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to show you is not just another market update. This is the kind of systemic warning that separates those who preserve generational wealth from those who watch it evaporate in real time. The bankruptcy rate in the United States just crossed 11%, marking the highest level we've seen since the great financial crisis. And if you think that's alarming, Dallas commercial real estate is now showing a 19% distress rate. But here's what the mainstream financial media is not telling you. Over $1.5 trillion in commercial real estate debt is maturing in 2026, and 70% of that toxic debt sits on the balance sheets of regional banks that are already stretched to the breaking point. We are witnessing the early stages of a commercial real estate collapse that will make 2008 look like a dress rehearsal, and the banks, the very institutions your parents told you were the safest place for your money, are trapped with no way out. This is not hyperbole. This is mathematics. This is history repeating itself with terrifying precision. In the next 25 minutes, I'm going to walk you through exactly why this bankruptcy wave is accelerating, how the maturity wall creates an unsolvable crisis for regional banks, and most critically, the three asymmetric plays you need to understand right now to not just survive, but thrive during this systemic dislocation. By the end of this video, you will have a clear action plan that most retail investors won't discover until it's far too late. So if you're serious about protecting your wealth and positioning for what's coming, stay with me until the very end. Before we dive into the mechanics of this unfolding crisis, I need you to understand one foundational concept that will frame everything else we discuss today. It's called the Rule of 72, and it's the simplest yet most powerful tool for understanding exponential growth and decay in financial systems. The Rule of 72 states that you can estimate how long it takes for any value to double by dividing 72 by the growth rate. If you have an investment earning 8% annually, 72 divided by 8 equals 9 years for your money to double. But here's where it gets dark, and this is critical. The rule of 72 works in reverse for debt and inflation. If a government is running deficits at 6% of GDP annually, their debt doubles in 12 years. If inflation is running at 4%, the purchasing power of your cash is cut in half every 18 years. Right now, the United States federal debt is growing at a rate that will see it double in less than a decade, and that's the official number, which dramatically understates unfunded liabilities like Social Security and Medicare. This brings us to the core thesis of this video, and I need you to understand this with absolute clarity. We are entering an era of financial repression, a period where governments and central banks deliberately keep interest rates below the rate of inflation to reduce the real burden of debt. This is not conspiracy theory. This is documented monetary policy that has been used throughout history, most notably in the 1970s and the period following World War II. Financial repression creates negative real interest rates, which means that even if your savings account pays you 3%, but inflation is running at 5%, you are losing 2% of your purchasing power every single year. The Rule of 72 tells us that at a 2% real negative rate, your wealth is cut in half every 36 years. But that's just the baseline. When we layer on the bankruptcy crisis, the commercial real estate collapse, and the regional banking stress we're seeing right now, the wealth destruction accelerates exponentially. The framework I'm going to teach you today is called asymmetric investing, and it's built on a simple principle. We are looking for investments where the potential downside is limited, but the upside is explosive, typically a risk-reward ratio of at least 1 to 5 or better. Think of it this way. If you can risk $1 with the possibility of making $5 to $10, and you can structure multiple bets like this across your portfolio, you only need to be right 20 to 30% of the time to generate life-changing returns. This is how the most sophisticated wealth is built during periods of systemic dislocation, and right now, with bankruptcies accelerating and banks trapped, we are sitting at one of the most asymmetric setups in modern financial history. To understand why the current bankruptcy crisis represents such a critical juncture, we need to look at history, because what's happening right now is not new. It's a pattern that repeats with mathematical precision whenever debt levels reach unsustainable heights and the financial system attempts to deleverage. Let me take you back to 1933, the depths of the Great Depression. By that point, over 9,000 banks had failed in the United States. Think about that number. 9,000 financial institutions simply ceased to exist, wiping out the savings of millions of Americans who believed their money was safe. The unemployment rate peaked at 25%. And the economic devastation was so severe that it fundamentally reshaped the relationship between citizens and their government for generations. But here's what most people don't understand about the Great Depression, and this is where the parallel to today becomes terrifying. The crisis was not primarily caused by the stock market crash of 1929. The crash was a symptom. The underlying disease was a massive debt bubble built up during the 1920s, combined with a banking system that was over-leveraged and holding assets that collapsed in value. When those assets, primarily real estate and commercial loans, started defaulting, banks had no choice but to call in other loans to maintain solvency, which triggered more defaults, which caused more bank failures, which destroyed more wealth. It was a deflationary death spiral. Now, the Federal Reserve at the time made catastrophic errors in monetary policy by tightening when they should have loosened, but that's a separate discussion. What I want you to focus on is this. The people who preserved and even built wealth during the Great Depression were not the ones who kept their money in banks or held onto stocks as they crashed. The wealth preservers were those who understood that the monetary system itself was being reset, and they positioned accordingly. After 1933, when Franklin Delano Roosevelt took the United States off the gold standard and devalued the dollar by 41% overnight through Executive Order 6102, gold was revalued from $20.67 per ounce to $35 per ounce. Those who had held physical gold outside the banking system, despite the government's order to turn it in, saw their purchasing power increase dramatically in a single policy decision. This is the lesson of the Great Depression that most modern investors have forgotten. When the system itself is in crisis, you cannot trust the system to protect your wealth. You need assets that exist outside the system, assets that have intrinsic value and cannot be devalued by monetary policy decisions. Now let's fast forward to the 1970s, a period that offers an even more relevant parallel to what we're experiencing today. The 70s were defined by stagflation, a toxic combination of stagnant economic growth and rising inflation that wasn't supposed to be possible, according to mainstream economic theory at the time. The decade began with President Richard Nixon closing the gold window in 1971, effectively ending the Bretton Woods system and moving the world to a pure fiat currency regime for the first time in history. What followed was a disaster for traditional portfolios. The stock market, measured by the Dow Jones Industrial Average, went essentially nowhere for the entire decade when adjusted for inflation. Bonds, which were supposed to be the safe haven, got absolutely crushed as interest rates soared into double digits. The 10-year Treasury yield went from around 6% at the start of the decade to over 15% by 1981. If you held bonds during that period, you watched your principal value get cut in half or worse. Real estate did okay in nominal terms, but was incredibly volatile and required active management. But gold and silver, the monetary metals, the assets that represent a store of value outside the control of central banks, went absolutely parabolic. Gold started the 1970s at $35 per ounce and peaked at over $850 in 1980, a 24-fold increase. That's not 24%. That's 2,400%. Silver was even more explosive, starting the decade at around $1.50 per ounce and hitting $50, a gain of over 3,000%. This was not a bubble driven by speculation alone, though speculation certainly amplified the moves in the final blow-off phase. This was a rational response by investors who understood that the monetary system was being debased through inflation, and they were seeking refuge in assets with intrinsic value that couldn't be printed by central banks. The lesson of the 1970s is clear. During periods of financial repression and currency debasement, you need to own hard assets that maintain purchasing power. The investors who followed conventional wisdom and stayed in a balanced portfolio of stocks and bonds got destroyed on a real, inflation-adjusted basis. The investors who understood monetary history and positioned in gold, silver, commodities, and certain real assets came out the other side with their wealth not just preserved, but multiplied. Here's what connects these two historical periods to today, and this is the part that should make you sit up and pay attention. Both the Great Depression and the 1970s were preceded by massive debt accumulation that reached unsustainable levels. Both periods saw asset bubbles that burst, creating defaults and stress in the banking system. Both periods required dramatic monetary interventions that fundamentally changed the value of currency and financial assets. And in both cases, the investors who won big were those who understood the game being played and positioned in assets that benefited from systemic dislocation. We are now in the early stages of the third great debt crisis of the modern era, and the playbook is repeating itself with eerie precision. The only question is whether you're going to recognize the pattern in time to act on it, or whether you're going to be part of the wealth destruction that inevitably comes when over-leveraged systems collapse. The bankruptcy rate hitting 11% and Dallas commercial real estate distress at 19% are not isolated data points. They are warning signals that the debt bubble is beginning to burst, And what comes next will separate those who understand history from those who are doomed to repeat it. Now let's shift from history to the present moment and break down exactly what is happening in the commercial real estate market and why this creates an unsolvable problem for regional banks. The numbers we're seeing are genuinely unprecedented outside of crisis periods. According to the United States Court's administrative data released just days ago, total bankruptcy filings in calendar year 2025 reached 565,759, an 11% increase from the previous year. Business bankruptcy filings specifically rose 7.1% to 24,737 cases. These are not mom-and-pop businesses quietly shutting down. These filings include significant commercial entities with substantial assets and employees, companies that were considered viable just 18 months ago, but are now being crushed by a combination of higher interest rates, persistent inflation, and weakening consumer demand. The acceleration is what matters here. We've gone from a low point of around 380,000 total bankruptcies in mid-2022 to over 560,000 now. That's a 50% increase in less than 3 years. This is not a gradual normalization. This is exponential growth in financial distress. But the real crisis is not in the bankruptcy courts. It's buried in the balance sheets of regional and community banks, and it's about to explode into public view. Here's the mechanism, and I need you to understand this with absolute clarity because this is the quiet bomb ticking in the background of every financial news story. Over $1.5 trillion in commercial real estate loans are maturing by the end of 2026. This is what analysts call the maturity wall, and it represents the single largest refinancing challenge the commercial real estate market has ever faced. These loans were originated in the mid-2010s when interest rates were near zero. Property values were rising and lenders were falling over themselves to write paper. A typical office building in Dallas or any major metro area might have been financed at 3% interest with a 5 to 7 year term, and everyone assumed that when the loan matured, refinancing would be automatic. Property values would be higher, rents would be stable or rising, and a new loan could be written at similar or even better terms. That assumption is now completely shattered. Interest rates on commercial real estate loans are now in the 6 to 8% range, more than doubling the debt service cost. Office occupancy rates have cratered due to work-from-home trends that are now permanent for many industries. Property values have fallen 20 to 40% in many markets, which means loan-to-value ratios that were conservative at origination are now dangerously inverted. When these loans mature, property owners are faced with an impossible choice. They can try to refinance at rates that make the property cash flow negative, which destroys equity value. They can inject massive amounts of additional equity to bring the loan-to-value ratio down to a level where a lender will refinance, which most owners simply don't have the capital to do. Or they can hand the keys back to the bank, walking away from the property and defaulting on the loan. Increasingly, option 3 is becoming the rational economic decision, and that's where the regional banking crisis begins. Regional and community banks hold roughly 70% of all commercial real estate loans in the United States. This is not widely understood by the general public. When people think of real estate lending, they often assume the big money center banks like JP Morgan Chase or Bank of America are the dominant players. But the reality is that large banks retreated from commercial real estate after the 2008 crisis and the regulatory scrutiny that followed. They moved to securitized lending and other less balance sheet intensive activities. Regional banks, the banks with $50 billion to $200 billion in assets, and community banks, institutions with under $10 billion in assets, filled that void. They built their business models around commercial real estate lending because it was profitable, it had strong relationships with local developers, and it seemed safe. Now, those same banks are sitting on loan portfolios where a significant percentage of the loans are maturing into a market where refinancing is not possible at terms that work. The official numbers on non-performing loans and charge-offs are still relatively low, but that's a lagging indicator. Banks have been engaging in what's called extend and pretend, where they modify loan terms and push out maturity dates to avoid having to mark the loans down and take losses. This strategy works if the problem is temporary and the market recovers quickly. But we are now 3 years into this commercial real estate downturn, and every data point suggests it's getting worse, not better. The maturity wall is not something banks can extend and pretend their way through. When a loan matures, the borrower either pays it off, refinances it, or defaults. There is no fourth option. And with $1.5 trillion maturing in 2026 alone, the sheer volume of loans hitting that decision point will overwhelm the system's ability to manage it quietly. Let me give you a specific example to make this concrete. Dallas, which is seeing a 19% distress rate in commercial real estate, is a canary in the coal mine for what's coming nationwide. Dallas had one of the hottest commercial real estate markets in the country during the 2010s and early 2020s. Office towers, retail centers, and mixed-use developments were being built at a breakneck pace, all financed with cheap debt from regional banks. The National, a 52-story mixed-use tower and downtown Dallas landmark, is now in foreclosure proceedings with Starwood Capital, one of the largest commercial real estate firms in the world, unable or unwilling to continue servicing the debt. If a property of that profile and with that level of institutional backing is going into foreclosure, what do you think is happening with the lower-tier properties financed by smaller regional banks? The Wall Street Journal recently published an investigation showing that downtown Dallas office vacancy rates are approaching record highs as companies flee aging towers for modern suburban campuses. This is not a temporary shift. This is a structural change in how and where people work, and it means that entire classes of commercial real estate, particularly older urban office buildings, have lost 30 to 50% of their value permanently. The banks that financed these properties at 95 or even 100 cents on the dollar are now looking at assets worth 50 to 60 cents, and the loans are maturing with no viable path to refinance. Now let's talk about the mechanism that makes this even worse, and this is where financial repression enters the picture in a very specific and dangerous way. The Federal Reserve has been engaging in a delicate balancing act. On one hand, they raised interest rates aggressively in 2022 and 2023 to fight inflation. On the other hand, they are acutely aware that if they push rates too high for too long, they will break the banking system through exactly the commercial real estate mechanism we're discussing. So what do? They hold rates higher for longer than many expected, but not high enough to truly crush inflation, and they provide behind-the-scenes liquidity facilities to banks that are experiencing stress. This is financial repression in action. Rates are kept below where they need to be to fully normalize inflation, which means savers and bondholders are earning negative real returns. At the same time, banks are being quietly supported to prevent an outright crisis, which means the cost of that support is ultimately borne by taxpayers and currency holders through debasement. It's a wealth transfer from the general public to the financial system, and it's happening in slow motion, so most people don't notice until it's too late. The people who understand this dynamic are moving their wealth out of the system and into assets that cannot be debased. Gold and silver become monetary insurance. Deep value equities and sectors that benefit from inflation become growth opportunities, and leveraged real assets in specific niches become wealth accelerators. This brings us to the three asymmetric plays I mentioned at the beginning, and this is where theory meets action. The first asymmetric play is what I call deep value in distressed credit. When the commercial real estate maturity wall hits and banks are forced to take losses, there will be a flood of distressed assets hitting the market. Properties that were financed at $100 million with $70 million in debt will be foreclosed and sold for $40 million because the banks just want them off their books. Distressed debt funds and sophisticated investors who understand how to underwrite these assets will buy the debt at 30 cents on the dollar and either restructure it or take control of the property. This is exactly what happened after the 2008 crisis, and it created some of the most spectacular returns of the past 2 decades. The key is that you need to be positioned before the wave hits, because once the distress becomes obvious, institutional capital floods in and the opportunities disappear. For retail investors, the cleanest way to get exposure is through specialized distressed debt funds or publicly traded REITs that are specifically positioning for this cycle. These vehicles typically trade at a discount to net asset value before the distress wave, and then close that discount and generate significant income as they deploy capital into distressed situations. The asymmetry comes from the fact that you're buying at a discount with limited downside, because these funds hold cash or safe assets, but massive upside when the distressed opportunity set expands. This is a 1 to 5 or even 1 to 10 risk-reward setup if you're in the right vehicles and you're patient. The second asymmetric play is leveraged inflation hedges, and this is where gold and silver miners come into play with explosive potential. Here's the setup. Gold is currently trading in a range that reflects some level of monetary concern, but it has not yet priced in a full-scale banking crisis or a significant acceleration in financial repression. Silver is even more underappreciated because it has both monetary demand and industrial demand, creating a dual catalyst. When gold moves from current levels into the $3,000 to $5,000 range, which is entirely plausible if we see banking stress escalate and central banks respond with liquidity injections, the stocks of gold mining companies move even more dramatically. A well-run gold miner with an all-in sustaining cost of $1,500 per ounce is currently generating modest margins at a $2,000 gold price. But if gold goes to $4,000, that same miner is now generating $1,500 per ounce in free cash flow effectively tripling or quadrupling their profitability. The stock market values these companies on multiples of cash flow, so a doubling of the gold price can easily result in a tripling or quadrupling of the stock price. Silver miners show even more leverage because silver prices tend to move faster and further in percentage terms than gold during monetary crises. The historical data is unambiguous. During the 1970s stagflation, silver mining stocks were among the best performing assets in the entire market, with some companies delivering 50 to 1 or even 100 to 1 returns as silver went from $1.50 to $50. We don't need that level of move to make life-changing returns. A silver move from current levels around $25 to $75 or $100, which is well within the range of possibility given the supply-demand dynamics and monetary factors, would produce 10 to 20 bagger returns in well-positioned silver miners. The asymmetry is that you're buying these companies at valuations that assume current metal prices persist indefinitely. But the upside scenario is a monetary shift that sends metal prices exponentially higher. You're risking 1 to make 10 or 20, and in a portfolio context, even a small allocation that pays off at those levels transforms overall returns. The third asymmetric play is what I call the systemic hedge, and this is where physical gold and silver come in, not as a trade but as insurance that pays off in catastrophic scenarios. Here's the reality that most financial advisors won't tell you because they don't get paid to recommend it. If the banking crisis escalates to the point where regional banks start failing in clusters, if commercial real estate losses force bailouts or bail-ins where depositors take losses, if the Federal Reserve responds with unlimited quantitative easing that sends inflation back into double digits, then the paper financial system loses credibility fast. In those scenarios, the best performing assets are physical monetary metals that you control directly, not through an ETF or a bank vault program, but in your physical possession or in secure private storage. Gold and silver have been money for 5,000 years across every civilization precisely because they cannot be printed, debased, or conjured into existence by government decree. They are the ultimate form of wealth that exists outside the system, and in crisis periods they become the ultimate store of value. The asymmetry here is different from the first two plays. You're not looking for a 10-bagger in your physical gold position. You're looking for purchasing power preservation in a scenario where most other assets collapse. But even on those terms, the math is compelling. If you allocate 10% of your portfolio to physical gold and silver, and we enter a period where the currency loses half its value due to inflation or monetary crisis, that 10% allocation has preserved the purchasing power of 50% of your portfolio because gold and silver will appreciate in nominal terms to offset the currency debasement. Meanwhile, the rest of your portfolio, the stocks, bonds, and cash, has been cut in half in real terms. The investors who had zero physical metals exposure just lost 50% of their wealth. The investor who had 10% in metals lost only 45%, and that 5% difference compounds over time and across multiple crisis events. This is insurance that you hope you never need, but if you do need it, it's the difference between financial survival and financial catastrophe. Now let's bring this all together into a concrete action plan, because everything I've discussed up until this point is useless unless you actually do something with it. The bankruptcy wave is accelerating. The commercial real estate maturity wall is unavoidable. The regional banks are trapped with no good options. The Federal Reserve will be forced to choose between allowing a deflationary banking crisis or engineering an inflationary bailout, and history tells us they will always choose inflation over deflation. This is not speculation. This is the lesson of every major financial crisis in modern history. Given that framework, here is what you need to do right now, and I mean this week, not next month. First, assess your current portfolio allocation and understand your exposure to the financial system. If you have significant cash in regional or community banks above FDIC insurance limits, that is direct exposure to the commercial real estate crisis we've discussed.